Good afternoon, everyone. Thank you for joining the JKH Investor Relations Webinar for the third quarter of 25-26. I am Gihan Kure, Deputy Chairperson and Group Finance Director. I am joined by Krishan Balendra, Chairperson and CEO, and together we will take you through today's proceedings. As per the usual format, we will start off with Krishan giving an overview of the macro as well as some of the key insights for the quarter, and then I will take you through the key insights of the financial performance for the quarter and the 9 months, and then open up for Q&A thereafter. If you have any questions, please enter it in the Q&A tab at the bottom of your screen. With that, I'd like to ask Krishan to start off things with giving an overview of the macro. Thank you.
Thanks, Gihan, and good afternoon, everyone, and thank you for joining our webinar. The macro environment, political and economic environment continues to be very stable. We had an unexpected event in Cyclone Ditwa at the end of November. Despite the early concerns about the extensive impact of the cyclone, we have seen that the impact on business has not been so significant. The impact on our own business performance has been quite marginal. And if we look across the country and other business sectors as well, the impact has not been as significant as initially feared. On the tourism sector, we feel that bookings or arrivals in December may have been about 5% less than what it could have been if not for the cyclone. And the estimate of damages to hotel properties, not the John Keells Group properties, but overall across the country is about 500 million rupees according to the Tourist Hotels Association. So not a significant number. The impact on agriculture has also, again, contrary to the early concerns, is not so significant. The estimate is that about 10% of the cultivated areas were damaged extensively, and partial damage to about a further 5% of the cultivated areas. And we can see that now with availability of agricultural produce. Initially, prices went up about 40%, but that has now settled, and we are also seeing availability returning to pre-cyclone levels. The banking sector, the estimate is that the impact of the cyclone is less than 1% of their portfolios, probably significantly less than 1%. So overall, the impact on business and the macro of the cyclone has been not so significant, and all the other macro indicators continue to be stable. Inflation is at a stable level. We have continued to see very good tax revenues and overall government revenue exceeding the targets. We are continuing to see a good fiscal deficit, a current account surplus, and post the cyclone, there has been a visit by the IMF team as they have held back the latest tranche until they assess the impact of the cyclone, and the press release after the recent visit was positive. On the debt restructuring, the final step was the restructuring of the Sri Lankan Airlines debt, and that was concluded in December. And very recently, just a couple of days back, the central bank made a statement that they expect that the country would be upgraded during the course of 2026. Some of the key sectors, consumption continues to be robust. There was some impact in the initial days because of the cyclone, but we are seeing volumes in our key categories continuing to be robust. Footfall growth in the supermarkets continues to be strong, and overall consumption continues to be very encouraging into January as well. Tourism, again, as I said, there was possibly an impact of about 5% or a little more on tourist arrivals in December, but December was still a strong month. And in January, on the numbers disclosed so far, up to the 25th of January, it appears we are heading for a growth of about 10% on last year, January, which was a record January. So 2026 January is also now likely to be a record in terms of tourist arrivals. So very encouraging. Arrivals from India in particular continues to show good growth. In the city of Colombo, we have seen increasing occupancy, which is a positive in the context of our City of Dreams project. So despite the significant increase in the supply of new rooms post the pandemic, construction of projects which had started prior to the pandemic getting completed in the last few years, a significant increase in supply. But despite that, we are now seeing strong occupancy in the city of Colombo. City of Dreams continues to get good momentum. As you would have seen with the numbers, we had a quarter of positive EBITDA. What is encouraging is that we are seeing strong interest for conferences and corporate events from overseas, in particular from India. The gaming operations is a highlight to attract corporate business and conference business to the property, as there is entertainment. The casino itself has seen a steady improvement in performance, and Gihan will go into more details during his presentation. West Container Terminal, the completion of phase 2 is on track and expected to be completed by the end of calendar year 2026, December 2026. Volumes have been very encouraging. We're actually now operating at close to full capacity utilization, and volumes are ahead of expectations. And in the quarter, the business reported a positive profit after tax. Volumes overall in the Colombo port are also strong. So despite the new capacity that the West Terminal has brought in, we have not seen a dip in volumes at SAGT, although there has been a slight decline due to some refurbishment and construction work that is ongoing and will be completed soon. But there has been enough demand to absorb the volume at the new volume or new capacity at the West Terminal. So I'll hand over to Gihan to run through the presentation on the quarterly performance.
Thank you, Krishan. So moving on to the performance for the third quarter, looking at the EBITDA for the quarter, we had a strong performance during this quarter, aided by contribution from across the portfolio. As you can see, we've seen growth in all our businesses during the quarter. The main business verticals have all contributed positively, and that has translated to EBITDA of 23.7 billion for the quarter against 14 billion last year, which is a growth of 68%. I will go through some of the numbers and of course get into further details when we get into each of the industry groups. But also just to point out that during this quarter, we did recognize, as we did last year, so the third quarter is when we recognize the fair value gains or losses on our investment property as per our year-end financial closure process. This is something we now do in the third quarter, which we did in the third quarter last year as well. So we did recognize a gain of 2.3 billion rupees across different investment properties, primarily at the office tower at the Cinnamon Life, as well as the retail mall at City of Dreams. So those were the main contributors to it. So we did see a slightly higher IP gain. So we are also just showing you, though that's part of the core part of the business, excluding that impact of what we did as IP gains this year and last year. If you exclude that impact, still it's a strong performance where the growth in EBITDA is at 63%, or in absolute terms was almost 3 billion increase in EBITDA compared to last year. Across the portfolio, you can see transportation had a strong improvement. Consumer foods, I'll explain later, we saw an improvement, but the business, particularly ice creams, was slightly impacted by the impact of the cyclone. Retail, of course, we have the John Keells CG, that's the BYD. The performance increased significantly. Of course, last year we didn't have the operations running, and against that we saw a 4 billion increase. But if you look at that in the context of the 9.6 billion increase for the quarter, you can see that there's a positive contribution right across the board. Supermarkets, we saw 21% growth in EBITDA. In supermarkets itself, it was about 25%, but this is the combined of supermarkets and John Keells Office Automation. COD, we saw an increase. I'll talk you through those when we get to the leisure slide. If you look at the cumulative performance for the 9 months, again, the strong performance this quarter, but even in the previous quarter, has helped translate to a very strong EBITDA cumulatively at 55 billion versus roughly 30 billion in the last year, which is about an 84% growth overall. If you look at the quarterly movement in EBITDA, I spoke of the quarterly numbers, but if you look at it in the context of momentum across the different quarters, you can see, as you know, generally Q3 and Q4 are sort of seasonal quarters for different businesses, leisure but others as well. So typically we expect to see Q3 and Q4 at a higher rate, but of course, like I said, against last year we've still seen a very strong improvement. But if you look at it on a quarter-to-quarter basis, you can see Q3 to Q4 last year, how that sort of performance does increase, particularly if you look at areas like leisure, where last year Q3 we did 2.7, but Q4 we did 5.6. As Krishan spoke earlier, the momentum on leisure, as we head into the peak season with Jan, Feb, March, we should see a similar sort of strong Q4, which should then sort of translate to a strong fourth quarter overall and cumulative performance as well. Just in terms of the finance costs, I won't spend too much time, but just to highlight here, when you look at the headline finance costs, there is an increase against last year, but that's really stemming more from the fact that we have a $194 million loan at City of Dreams, Sri Lanka, and because of the depreciation of the rupee, there's a non-cash but an exchange loss that we recognize on the loan of about 1.4 billion rupees, which is included in the finance cost. So if you eliminate that impact, really the finance cost hasn't really moved up very significantly, and the increase is really coming more from retail, which is also coming from JKCG, BYD, which wasn't in operation last year. So these are all trade financing facilities and the interest cost stemming from that. So that's a sort of more normalized increase that we are seeing. But as I said, the main impact is because of the exchange loss. If you look at the PBT performance, again, a very strong growth in PBT. So if you look at it from 6 billion last year to about 12.9 billion this year for Q3, which is an increase of 6.8 billion and 113% increase. There are some adjustments that we've made just to show you, like I said, the fair value gains, which I already spoke of, but also this quarter we have a net exchange loss of around 760 million, partly due to the loan loss that I spoke of earlier, the translation loss on COD. We had some exchange gains as well, because we are holding excess dollars in some businesses, but the net impact of that still was a loss of about 760 million rupees, whereas last year we had a gain of 780 million because the rupee appreciated in the quarter So as a result of that, if you look at that sort of delta, it's about 1.5 billion. So excluding that impact, you can see it's a stronger performance, but if you look at the headline, still it's a very strong improvement in PBT for the quarter. Similar sort of translation if you look at it on an attributable PAT basis as well. I won't go through the details. The numbers are largely in line, but of course this is at an attributable PAT level. So if you look at the numbers, it's slightly different, but overall the performance is strong. The main reason here between PBT and attributable PAT is that we own 50% of JKCG, but still overall you can see there's a 3.6 billion rupee improvement in attributable PAT, and the contribution from JKCG was about 1.3 billion of that. Looking at the balance sheet, our debt numbers overall on a gross basis quarter to quarter, we are comparing Q2 to Q3, is largely in line with what we saw previously. Net debt has gone up slightly as we have used some cash into Cinnamon Life. But if you look at it also on a gross basis, JKCG, that's the BYD business, is one of the main reasons for the sort of increase in debt. So there's about 15 billion of debt in JKCG. Of course, last quarter also we had that similar sort of quantum, but if you look at it against last year, that amount has come in over and above what we had before. Overall, on a net debt to equity, it's at about 32%, which is at a very comfortable level. And of course, this is the quarterly EBITDA, and we can't annualize that number, but if you look at just the run rate of the cumulative EBITDA, even net debt to EBITDA would be at a very comfortable level. I won't go through the details of this in terms of our ESG initiatives, but I think the first bullet point, Krishan spoke of the impact on the cyclone, and the impact on the economy fortunately is not as much, but there are social impacts in terms of the number of people who were affected, and JKH and our affiliates together contributed around 500 million rupees towards the government's Rebuilding Sri Lanka effort. And on top of that, of course, there were other initiatives by our businesses as well as volunteers who helped in the immediate aftermath of the incident. Moving on to, this is just an image of the West Container Terminal. As you can see from this image, the yard spaces are quite full, and that's sort of reflective of the type of capacity utilization we are seeing right now. This is an image of the West Container Terminal with the office building and the yard and cranes in the background. So as Krishan also mentioned, we have very strong momentum with sort of month-on-month improvement in throughput. Right now we are running at about 90% utilization of phase 1 capacity, which is very remarkable and promising given that we started operations only in April. And also that performance has now translated to a financial implication which is very positive, in that we are recognizing a positive profit after tax, which is ahead of expectations, and this is what we recognize even at EBITDA level is actually our share of PAT, which includes then the depreciation and the interest, of course, the components that are attributable to phase 1. Overall, I think Krishan already spoke of construction progress, so I won't spend time on that. If you look at the volumes here on the chart, you can see how each quarter the CWIT volumes have increased, and overall port volumes have increased as well. SAGT, the decline is, as Krishan mentioned, we are doing some repairs on the crane rails, and as a result of that, the number of ships that could berth was somewhat impacted, but from December and particularly January onwards, we've managed that, and whilst there will be some disruption, the level of disruption shouldn't be as significant as we saw in Q3. If you look at the numbers, so that, as I mentioned, if you look at SAGT, we've seen a decline in volumes purely due to that reason. At CWIT, we've seen, as you saw from the previous slide, 360,000 TEUs for the quarter. The domestic to transshipment mix has sort of continued to improve quarter on quarter, and will get better as domestic import-export volumes also increase. The bunkering business, we saw very strong performance during the quarter, particularly driven by record high volume growth of 43%. So it was a very strong quarter, and we saw some improvement in margins as well, but it's really the volume growth that helped drive the business. So overall, combining all these impacts, we've seen a strong EBITDA growth in the transportation business. Moving on to consumer foods, we saw marginal growth in confectionery volumes of 2%. Beverages grew at 17%. So that was a positive despite the impact of the cyclone. Confectionery was more impacted given the cold chain and the nature of distribution, and also in the immediate sort of aftermath, given that it's sort of more impulse products and so on, we did see an impact, but we should see Q4 get back to normalcy. We did see an impact on our margins quarter to quarter. If you look at it, we've seen a slight decline. That was again mainly due to the confectionery business because we saw a mix change. So if you look at the numbers in terms of the bulk to impulse against last year, we've seen a higher ratio of bulk to impulse, or even if you look at it from Q2 to Q3, that's because we saw impulse volumes which were more impacted in the immediate aftermath of the cyclone. So that does affect margins. Plus we are launching some new products in this quarter on extruded products. So there were a couple of other impacts. We also saw with cocoa prices increasing, there was some pressure on margins in the ice cream business as well. So some of those impacts, of course, we will look to mitigate in the coming quarter and going forward. But with volumes increasing and as well as the bulk to impulse ratio getting back to more normalized levels, we should see margins recover to some extent. So overall, we're still up quarter to quarter, last year to this year. But as I mentioned, margins were impacted mainly because of the confectionery business. I won't spend time on this slide. This just shows you that in terms of our volumes, we've still seen volume growth against last year. And of course, just to remind you, if you look at this chart, you see that Q4 volumes typically for CSDs tends to be at a peak. And even if you look at confectionery, you see the same sort of impact in Q4, which we expect to see this year as well. In our retail business, this is the supermarket business. We saw a strong performance with about a 25% growth in EBITDA in supermarkets. Overall EBITDA of the retail industry group itself, of course, was driven by a strong performance or contribution from JKCG, which I'll talk to you on in the coming slides. Supermarkets was driven by same-store sales growth of about 14.3%. We have adjusted this to eliminate the impact of the outlets that were affected by DITWA. So it's adjusted to that extent, but we saw about a 14.3% growth driven by footfall. So as you can see right across the 5 quarters, we've had very strong footfall growth, which is what has driven same-store sales. But this quarter now, with inflation sort of ticking up and sort of central bank also in its policy roadmap spoke of the fact that they believe inflation will slowly head towards its target of 5%. We've seen a positive contribution on ABV compared with the last 3 quarters. So overall, the supermarket business saw a very good EBITDA margin of 8.5%, which is an improvement against Q2. Of course, it is a stronger quarter, but even if you look at Q3 last year, it's an improvement against the 8.1% we saw last year. I'll just skip this slide. This just gives you a breakup of how things have been tracking on EBITDA margins. In terms of the decomposition of our same-store sales growth, as I said, it's driven mainly by footfall. We saw inflation being in positive territory. If you look at Q3, the NCPI was close to 3%, though for the quarter, of course, we saw a slight positive contribution from RSP or retail selling prices. Moving on to our BYD business, these are just some images of our launch of the Denza, which is the high-end range of BYD, which we are now importing, as well as some of our other products. Again, a strong quarter. So we've seen, of course, there was a lot of pent-up demand in the last year and strong sales. That momentum naturally has sort of more normalized, but we still have a very healthy pipeline of about 3,900 vehicles. As I mentioned earlier, we launched the Denza brand, as well as we've launched different products in the portfolio, and essentially with that we are seeing sales momentum, maybe not at the same level, which, as I mentioned, everyone expected to normalize. For the quarter, we sold and handed over about 2,000, close to 2,000 vehicles. Q2, of course, was a peak, but it's sort of in line with what we did on average in Q1. And the EBITDA contribution from the business was about 4 billion rupees. Moving on to leisure and tourism, Sri Lanka, as Krishan said, we are seeing very good momentum. And if you look at the month of January, this is of course till the 25th of January, we've done about 223,000 arrivals against 252 for the entire month last year. So we should be on track to sort of better that number. And overall tourism momentum for this quarter, which is a peak season, is looking very positive. In the Maldives as well, again, the overall arrivals number is looking good, and sort of the outlook for the quarter again is looking positive. Looking at the performance, the Colombo hotels, this is Cinnamon Grand and Cinnamon Lakeside. Occupancy was higher than last year. ARRs were slightly lower because of the increase in inventory across the city. But on a RevPAR basis, as you can see, we've done better, and that's translated to better EBITDA margins. Similarly, if you look at Sri Lankan resorts, it's actually an improvement on both occupancy and ARR, which has then translated to a very strong EBITDA uplift from 23% last year to 35% in the current year. In the Maldives, the headline numbers did improve. Occupancy and ARRs got better, but in dollar terms, the performance was slightly lower because we did see some higher costs coming in as well. So on EBITDA, we were slightly lower, though that was offset to some extent because of the depreciation of the rupee. So in rupee terms, we were better, but the increase in occupancy and ARRs was not enough to offset that, so which is why you see a slight decline in the EBITDA margins. But overall, if you look at the performance of leisure, very strong performance in terms of EBITDA contribution, driven also by Cinnamon Life, which I'll talk you through. So as Krishan mentioned, last quarter was the first quarter that we recognized a positive EBITDA of 1.4 billion for COD Sri Lanka. That includes a fair value gain of 600 million, which is part and parcel of the business, but even without that, it's a strong positive contribution, and the main thing is that we're seeing very strong momentum for this business. If you look at the numbers, we've seen occupancy increase to 45% from 35%, and ARRs did increase, but just to point out here, as the asterisk here shows you, that Q1 and Q2 previously we were reporting on Cinnamon Life, which is the 687 rooms, whereas now from this quarter, because we've had Nua, which is the 113 keys managed by Melco, that's been open for the full quarter from September onwards, though we opened in August. So we have now brought in that, and we are reporting the blend of the entirety of the 800 rooms. So the ARR itself is not necessarily a apples to apples comparison, but if you look at Cinnamon Life alone, we've sort of maintained the same ARRs, but overall occupancy is high as well. I'll spend just a minute on this because it's important to understand the performance of COD. If you look at it last year, we were doing about a 1.5 billion negative EBITDA, which has now translated to a 1.4 billion positive EBITDA. So it's about a 3 billion rupee turnaround in terms of EBITDA. If you look at it sort of quarter to quarter, you can see the trend of how the numbers have sort of come down from there. Last quarter, we almost broke even, and now you can see the impact that we're seeing here. If you look at the depreciation amortization, it's largely in line on a quarter to quarter basis. Interest cost has actually come down slightly. The big impact, of course, is, as I mentioned before, the impact on the exchange loss in this quarter, compared with a gain last quarter. So as a result of that, if you look at the PBT compared to last year, we are only marginally better on a PBT or PAT basis. But if you actually look at the impact of the plus 800 versus a minus 1.3 billion, it's about a 2.2 billion negative impact because of the exchange impact. So if you eliminate that, you can see that the momentum is on COD Sri Lanka is quite strong. Moving on to our property business, we've seen decent momentum on our sales. Cinnamon Life, it's been slow, but we are sort of every quarter we are seeing some level of sales. We are now at 75%. Trizen, we continue to see decent sales, and now we've moved up to 85%. On Viman, here we are reporting on all 4 phases, which is why it's 53%. But if you look at phase 4 was only launched end of November, so we really had only a month since we launched it, and we sold just 1 or 2 units. But if you look at just phase 1 to 3, we are at about 84% of sales on the first 3 phases. Overall, EBITDA in the business also improved. We did see a slightly higher Invest IP gain compared to last year, but still eliminating that impact, we've seen a good uplift as we start recognizing revenue from some of these projects, particularly Viman, which will now ramp up as we get closer to completion of phase 1. Lastly, on financial services, we saw this is of course the Q2 numbers, because both financial services business are December year-end companies, so we don't have the final numbers. But overall, if you look at it, the EBITDA was a very marginal growth. But I'll just talk about NTB, where we didn't talk of this in the last quarter. So we've seen very strong net profit growth in Q2 as reported by NTB of about 48%. Strong loan growth, as well as if you look at the stage 3 loans on a net basis have continuously come down. So the quality of the portfolio as well is very strong. NTB, we spoke of the acquisition of the retail, the local portfolio of HSBC. Central bank approval was obtained in the last quarter, and the transition is progressing well. That brings us to a close on the presentation. Just to remind you once again, if you have any questions, please enter it at the bottom of your screens and on the Q&A tab. Krishan, if I may just open with the Q&A and ask you maybe to elaborate a little bit on where we are with, we spoke of the sales and the outlook for BYD, but just in terms of where we are with the particular vehicle models and the customs case.
Yes, so the case is ongoing, and what we are continuing to clear certain models by going to court and getting them cleared. The a couple of models we are not importing, where there is a significant duty impact based on the outcome of the case, but all the other models we continue to import and have cleared through a court process. Some of the models are brought in on bank guarantees, and some models are cleared on corporate guarantees. So except for 2 models, all of the other models that we have been marketing in Sri Lanka, we continue to market, and we expect to introduce new models as well to the market. BYD has an extensive range, electric model vehicles as well as the hybrid models. The hybrid vehicles are not impacted by the customs issue. It's only the pure electric vehicles. So as I said, more models will be introduced to the market, and we are confident that we will continue to see good sales in the business.
Thanks, Krishan. There are a couple of questions on, maybe I'll try and deal with it in one go, on City of Dreams, whether the reported EBITDA includes the rental portion for the casino space. Yes, it does. So in this quarter, as we did in the previous quarter, but this was the first full quarter where we recognized the fixed rental element from the casino space, so that is within the numbers. But given the sort of momentum of the business and ramp up, we are still not at the point where we're recognizing a variable revenue there. Also on, there was a question on COD in terms of the outlook. Maybe Krishan, I'll pose that question to you, not just on COD, but the same momentum of ARR and occupancy for resort and city hotels in Q4. Q4, of course, is sort of even more of a peak than Q3, but maybe if you can shed some light on that.
Q4, the Sri Lanka resorts and the Colombo city hotels, the outlook is very positive. As you saw, even in Q3, we did a much stronger RevPAR in the Sri Lanka resorts. And despite the new supply, which has brought pressure on room rates in the city, we did a very good RevPAR compared to the last couple of quarters and year on year as well in the city. What we have seen with the resorts, there was some impact in the what we call the round trip hotels, Kandy and Habarana, because of the cyclone in the month of December. But we are seeing a recovery in January. So this quarter, the resorts will be much stronger and should achieve a much better revenue per available room or RevPAR compared to last quarter. The city is what has really surprised us positively, in that in the last few months we have seen increasing occupancy. With all the new supply of rooms that have come into the city, we had seen occupancies drop to levels of like 50% overall in the star class category, or even lower. But we have seen much higher occupancies in the last few months. And in the month of January as well, we expect that the city will do an occupancy, possibly, we don't have the final numbers yet, but possibly over 70%, and we should be able to sustain that over the next few months. The City of Dreams occupancy has been picking up steadily since we opened. We opened the Cinnamon Life Hotel in October 2024, and then the Nua Hotel, and of course the casino in August 2025. We have seen a steady and encouraging increase in occupancies since then with each month. And what is most encouraging is, given the banqueting and conferencing spaces at City of Dreams, we are seeing good demand for foreign conferences and corporate events. Actually a little ahead of our expectations, in particular from India. And we have seen the confirmation of a very big global conference where the main hotel will be the City of Dreams or Cinnamon Life, which will be held in mid-2026. And one of the other highlights of this demand is that we are seeing that some of this demand is being generated because there is entertainment now in the city, and in particular in the City of Dreams complex, with the world-class casino facilities. So the momentum for the city overall is encouraging, and for City of Dreams in particular, it is quite encouraging.
Thank you, Krishan. There are a couple of questions. Maybe, Krishan, if I can just ask you on the casino, how the footfall compares to other gaming options in the city. If we can just sort of give a sense of maybe how we are doing overall.
Yeah, we don't, I mean, these are not disclosed data in terms of footfall overall in other gaming operations in the city. And I think the key metric here is not really footfall, but spend per visitor. So what the business is focused on is attracting the higher spending visitors to the casino. We are seeing a steady improvement, as we said earlier. So I can't really talk about market shares or how our footfall compares, because it's not available data, publicly available data, but really the focus of our operation is to attract higher spending gamblers to the City of Dreams casino.
Thanks, Krishan. On the casino, I think we clarified this earlier, but maybe just to repeat, there's a question whether the variable rent has kicked in. It has not yet kicked in, and what we're recognizing is the fixed rental component. On CWIT, whether there was any tailwind from the fact that SAGT did see an impact on maintenance. Not at all. I think it's the fact that Colombo was badly in need of deep water capacity, and overall port volumes have grown, and the ability to sort of attract new vessels coming into Colombo, that's what has driven volumes in the port of Colombo as well as CWIT. So there's not really a tailwind impact because of that. It was actually net new business that's coming into Colombo. In terms of domestic to transshipment, it's difficult to sort of put a number down. That number will increase for CWIT, but of course the overall, whilst the domestic numbers will grow, it's off a lower base in any case, and of course the new demand that will really come in will be more transshipment volume. So it's difficult to sort of give a sense of where that is, but typically the domestic to transshipment mix could be around 15 to 85% domestic to transshipment. So CWIT also should be able to sort of get to a similar sort of ratio. In terms of the BYD case, there's a question if we can quantify the contingent liability on this. So our position has been very clear in terms of the fact that we don't believe there is a liability, and in terms of quantifying it in any case, there's no ability to quantify it because it depends on what sort of assumption one uses in terms of that differential on the type of capacity. So there is no requirement for us to, there's no basis actually for us to quantify, and therefore there's no contingent liability that anyway arises as a result of this. There's a question on the number of units of Viman for phase 4. So it's about 150 units that we have now opened out there. We are unable to give guidance. The question asks how many we will be selling, but as I mentioned, on phases 1 to 3 we are about 83-84% sold, and if you look at the momentum of the sales that we saw in phases 1, 2, 3, we should see a similar sort of momentum with phase 4 as well, though it's difficult to sort of give you an exact number. During the quarter, we established 2 outlets in our supermarket business, and in the next financial year we expect to typically look to open about 12 to 15 outlets is our plan. There's a question on sharing some insight on the John Keells Logistics Distribution Center, and that fact that it wasn't referenced in the commentary. Yes, the commentary has focused more on the sort of larger businesses in terms of the port and bunkering and so on, but overall we've seen good uptake on the distribution on logistics. The sort of warehouse utilization is now sort of almost at 100%, and that has also enabled the business to sort of manage yields and ensure that the margins of the business has improved. So it is contributing positively as well, but as I mentioned earlier, the larger material contributions to the performance of the transportation group come from the ports and bunkering business. There's a question on the nature of the repair and maintenance cost in the Maldives, whether it's an ongoing activity. There were some other costs. It's not really R&M sort of cost. We also saw an increase due to the minimum wages that were brought in. So if you look at last year to this year, there is slight impact from that, as well as some insurance costs that have gone up as well. And yes, there's some element of repair cost, but it's a few items like that that have just contributed to that impact, which hopefully in this quarter, with the sort of improved occupancy and ARRs that are expected in Q4, should absorb that type of impact. Krishan, there's maybe 2 questions. One is whether there's any refurbishment plans for Keells Hotels properties in the near term. And also there was another question on whether we are looking to add any new hotels in Sri Lanka.
On the refurbishment, there is nothing imminent. I think the question we keep getting asked is about Cinnamon Grand and Cinnamon Lakeside. I mean, occupancies, yes, have improved, as I said, and rates are starting to pick up. So we will have to look at this. I think we'll have to look at it fairly soon, but we haven't made a decision on the city properties. In the resort properties, there is nothing, again, nothing imminent, and the refurbishment is not required because we had either refurbished or rebuilt most of all our properties prior to COVID. So where you may see some refurbishment is if we decide to reposition a resort property, but as at the moment there is no specific plans to refurbish any of our properties. On any new builds, if you look at the resorts in particular and the occupancies and ARRs that we are achieving, especially in our newest property, the rebuilt Cinnamon Bentota, there is now possibly a case to justify building a new resort. We have a lot of undeveloped land in locations, in prime locations, in resort locations in Sri Lanka. Again, no decisions have been made, but with the kind of RevPARs that we are now starting to see, there may be a case to look at building a new hotel.
Staying with leisure, Krishan, there's a question saying, given the strong TripAdvisor performance of the group's Maldivian resorts, whether there's scope for pursuing management opportunities elsewhere in the region.
Yes, we are constantly on the lookout for new management opportunities in Sri Lanka, in the Maldives, and elsewhere. There isn't anything specific that I can comment on.
There's a question on the reason for the supermarket margin improvement. It's a couple of factors, of course, with the sort of footfall growth and same-store sales. The base is also higher compared to last year, so that helps in terms of margins or dilution of fixed cost. But at a GP level, at a gross margin level also, we've seen an improvement driven by some of the activities that the business has been pursuing. The mix as well, so when you have more fresh prepared food and so on, that also can contribute to higher margins. So we've seen those sort of initiatives contributing to that, and that has sort of then translated, as I said, the combination of higher volumes as well as those sort of initiatives which has translated to better margins. There's a question on the minimum ROE JKH is looking to gain from NTB in the next 3 to 5 years. I think NTB has been doing a sort of almost above market ROE, and if you look at the banking industry, it's been one of the top performers in terms of ROEs of banks, and it's been at about 20% plus. So I think if you look at it, that's a very strong, healthy ROE for a bank, and we'd like to see that same momentum continue. And even with the sort of acquisition of the retail banking portfolio of HSBC, with the sort of synergies that the bank can extract, we believe that overall it will, in steady state, sort of help to even grow that possibly even further. There's a question on the large capex increase in CCS in 3Q. I touched on the fact that we are launching some extruded products. So there was an investment in extrusion line, during the year last year. So there's capex related to that, as well as some of our other investments on cone bakery and things like that, which has also added to the capex, which is really just creating new capacity and capability as well. There's a question on the occupancy at Nua and whether it's rental income for JKH. Nua is actually, the asset is owned by JKH, so it's just managed by Melco. So the revenue and everything is actually just consolidated in our financials. The only difference with Cinnamon Life and NUA is that there's a management fee that's paid to Melco, but otherwise the top line and costs and everything is actually on our P&L. In terms of the overall occupancy at NUA, we are not, as I said, disclosing it separately because we are looking at the entirety of the 800 rooms, but it's a smaller hotel, but the occupancy has been quite strong and in line with what we've sort of reported overall. There's a question on the CSD volume growth and whether it had anything to do with the cyclone relief efforts or is it organic volume growth. It's not necessarily linked to relief efforts, but yes, we did see a slightly stronger quarter. Overall, like I said, ice creams was more impacted because of cold chain disruptions to the network as well, and that's been the main reason. But overall volumes in beverages, we expect to sort of see that momentum continue through Q4 as well. There's a question on the repayment plan for the term loan at Waterfront Properties. As we've said before, anyway, that loan is due for refinancing or repayment in December 2026. But we are working on looking to refinance that ahead of time so that we could take advantage of the fact that we believe that we will be able to actually refinance it at a lower finance cost. And we are hoping to sort of do that and complete that before the next financial year. There's a question on the increase in the marine services volumes. I think it's the LMS volumes, the bunkering volumes, and what really drove this. It was primarily, if you look at Sri Lanka's location, naturally we benefit from that and we get bunkering volume as a result. But also what drives volume is if you look at the price gap between what Sri Lanka is able to offer and then regional markets and particularly even India. So Sri Lanka, the price gap between Sri Lanka and India has also now in the last quarter reduced to an extent, and as a result we were able to drive more volume, and that's been the primary reason for that. There's a question on COD in terms of how much revenue do banquets and events account for. We don't give that breakup specifically, but naturally given that banquets have been doing well, that is quite a significant contributor to performance, though we don't sort of break that up at this moment of time. There's a question on what is a comfortable gearing debt to equity ratio for JKH in the medium term. So as we've said, I mean 30% net debt to equity, I mean not just JKH, but if you look at it on a normal basis, that is quite a comfortable level. But if you look at the cash generation of our businesses, as you've seen with the type of EBITDA we are generating, and we expect that momentum to continue not just in Q4 but heading into next year as well, then you will start seeing that sort of having a positive impact in terms of our leverage levels as well, which should start coming down. But as I mentioned, it's already at a comfortable level. There's a question that the flooding may have impacted competition as well for the quarter in terms of our beverage business. There is an impact, yes, with the competition having been one of the competitors also being affected, and that did sort of aid in some volume uplift for the quarter. But overall, it is a stronger season, so we've seen that benefit. But yes, there was a positive impact coming through that as well. There's a question on opportunities in terms of our city hotel portfolio, Krishan, whether we are doing anything, but I think we already addressed that. And any sort of update, Krishan, that we can give in terms of the Vauxhall Street property and our plans around that, whether we can share any perspective on that.
Yeah, as we've been saying, that our next apartment development is likely to be on the Vauxhall Street property, where we own about 9 acres of land on freehold on a freehold basis. We've seen the apartment market gradually pick up after the economic crisis. We've had good sales across our 3 developments, Cinnamon Life, Trizen and Viman. In Trizen and Viman in particular, so it is likely that we would launch something as our next project on the Vauxhall Street property in the near future. But there is no specific timeline that I can comment on.
Thank you. There's a question on the run rate for December, the quarter on BYD, whether that's considered a normalized level of sales or whether there's an element of pent-up demand. It's a little difficult to say how that would be because if you look at it, yes, we have an order book of about 3,700 vehicles, so the momentum for Q4 certainly will be there. Heading into Q1 next year also, we should have some momentum, but it's difficult to sort of segregate as to how much would be, whether there's an element of pent-up and where the normalized level could be. Of course, the benefit that we have is BYD has an extensive range, a portfolio of products, and more recently we've launched more on the entry-level side of the product portfolio. As Krishan spoke earlier, yes, we still have some challenges in terms of some of the EVs, but we're able to bring in some others and clear them on corporate guarantees. So if the full range is available, I think we could do that much better. But at this moment, still with the type of portfolio we have as well as the hybrid range, we think we can sort of maintain a certain momentum. But it's difficult to break that up into how much is pent up versus normalized. There's a question on the hotel space that we are renting out at Cinnamon Grand, because one wing is operational as a hotel and the other wing where we are not running all the rooms, but we are just sort of renting out some of those spaces out. It's just an initiative in terms of, rather than trying to refurbish those rooms, and at a time when it wasn't efficient for us to run the entirety of that block because of the ACs and the staffing and all, it was more productive to sort of not run those as hotel rooms. And then the logic was that we can get some yield out of it by renting out. So that was the rationale behind it, and we sort of managed to mitigate or reduce the cost of running that wing as a result of that. There's a question, Krishan, which is looking more to the future in a sense. With all the building blocks in place now, what is next for JKH looking into 2026 and beyond?
I think 2026 and the immediate future is about maximizing the returns on some of the large investments we've made. And there is quite a runway there where we should see increasing returns over the next few years. And also the continued organic investment. We keep adding new supermarkets. We are targeting to add at least 15 new supermarkets annually. With the volume growth we are seeing in our consumer side, it is likely that we will need new capacity over the next few years. So we will add more manufacturing capacity in our consumer business. And as I said earlier, with the kind of ARRs that we are now seeing in some of our resort properties, you may see us developing in some of those prime lands that we own in resort locations. But there isn't anything specific and big that I can comment on at the moment.
We are almost out of time, and we've run through all the questions. There's just 2 questions that I will pick up, and those are the last 2 questions that we have. There's a question on whether JKH is paying a finance cost for the corporate guarantees for clearing the BYD vehicles. So there are corporate guarantees. So for those, there's no finance cost. It's just a corporate guarantee on the value. But the previous, some of the vehicles were on bank guarantees, so there's a cost attached to the bank guarantee. But the more recent ones have been on corporate guarantees, and there's no cost. Krishan, last question to you. Any plans to increase the current dividend? Seems like the normal payout is now 10 cents a quarter. Of course, normal, as in we had increased it from the last quarter.
Yes.
So we're maintaining the 10 cents, but that's doubling from what we were doing previously.
Okay, I can't really comment on that. We've now effectively doubled the dividend from what we were paying in the last few years, and any increase will really depend on the performance of the businesses over the next few years. So I can't really give a guidance or make a specific prediction on where our dividends are likely to be.
Thanks, Prashant.
Yeah.
So that brings us to a close. We've completed all the questions that were posed to us. Thank you very much for joining us at our webinar this time as well. As usual, we will be posting the clip on the webinar. It'll be on our website in the next couple of hours, and we'll also have a transcript of the webinar posted on our website in a couple of days' time. Thank you once again for joining us.